Welcome to Finance in 5. Today we're looking again at Michael Burry and the portfolio of Scion Asset Management. And yes, I am talking about where the cash of Scion Asset Management has been deployed as of May 2020 based on the latest information. So far I haven't found any other videos covering this on YouTube, so I'm going to cover it myself. Some of the changes are that aside from buying new stocks and unloading old ones, Burry has added leverage with call options after the COVID-19 market decline. A number of retailers which will soon begin trading again enter the Scion portfolio, including casino, restaurant and retail stocks. His May 15th 13F filing gives us a once per quarter glimpse at his portfolio.
Mr. Fields' suit is very specific to files from the past year.
Good, then get out.
This form has to be filed quarterly by institutional investment managers with at least $100 million in assets under management. We're going to look at the new investments listed in this filing, and briefly we'll discuss those companies which are notable by their absence. Coming up today on Finance in 5. So welcome back, and my apologies for the break. As much as many listeners have asked that we explore other topics, one eagle-eyed subscriber pointed out that Michael Burry filed his SEC form on the last day of the deadline, and that the information that it provides could be useful for subscribers to this channel. It is interesting to consider the fact that in this new post-COVID-19 world, Michael Burry has made a number of important capital allocation decisions.
I'm not sure what you want me to say.
I think you've already said it.
For convenience, I've included the present portfolio plus the portfolio at the end of 2019 for comparison purposes. I'm going to be focusing today on the new purchases. There's going to be a footnote at the end concerning the positions that Burry has sold or closed.
It's Dr. Burry. Looks like the collapse of the financial sector is imminent. I start to sell my position. It's $1.3 billion. Sure, I'll hold.
Due to the fact that we're talking about 9 stocks, there's a limit to the amount of time that I can dedicate to each one, but I'm going to touch on each of them alphabetically. Boeing, 60,000 shares, $8.94 million. The aeroplane manufacturer has suffered considerable COVID-19 risk as its customers are the airlines, which are still grounded for the most part throughout the world. Citizens are well aware of the fateful Boeing 737 crashes in Ethiopia and Indonesia. But now Boeing has suffered a collapse in its orders and is selling its property on top of dealing with safety concerns. While it has significant backlogs of orders for many of its planes, it seems likely that new orders will be scarce for quite a while after the pandemic abates, and some have been cancelled as we see here. April 2020 saw the company receive a record-setting 0 orders to manufacture commercial planes. And of course, the 737 MAX still has not been approved for use, which keeps their product out of the largest market segment. Concerns about cracks on the wings of their planes have naturally got Boeing into a flap. It does seem likely that the stock will get a one-time bounce when the 737 MAX return to service is announced, and the price was badly beaten down in the first quarter of 2020. However, the stock is suffering and there's plenty of negative news sentiment surrounding this company at present. In the current environment of government spending, however, both coronavirus-related as well as the enormous Trump military budget commitment, it seems likely that space and defense businesses will continue to do well, so that is another potential source of upside here. Boeing is a huge company whose specialties include missile defense, maritime surveillance, reconnaissance aircraft, and much more. At the same time, many analysts are skeptical. Boeing's order backlog for commercial aeroplanes shrank by more than 500 units in the first 4 months of 2020. Cancellations will likely continue to outnumber new orders over the next 12 to 18 months, since struggling airlines are unlikely to have ready cash to buy new planes. Many orders on the books will be deferred indefinitely and can't be relied upon for projecting future production rates. Boeing is cutting output dramatically, but production rates may need to go lower still. This is going to weigh heavily on cash flow over the next several years. 2 of the top 3 737 MAX customers are Fly Dubai and Indonesia-based Lion Air. Both airlines have over 200 planes on order, which is far more than they need. Lion Air has been threatening to cancel its 737 MAX orders for over a year, feeling that Boeing threw it under the bus by blaming its staff for the first fatal 737 MAX crash in late 2018. Beyond the 737 MAX, though, the company has been facing a litany of issues in its other segments. Regarding its defense business, the KC-46 Pegasus aerial refuelling plane, which was a $44 billion project, has been a source of constant headaches, and despite years of work and being billions and billions of dollars over budget, it remains delayed. Its struggles on this project have led it to be criticised not just by politicians, but also by military generals who have been angered by the delays and problems with this aircraft. In January, Air Force Chief of Staff General David Goldfein even declared that the Air Force continues to accept deliveries of a tanker incapable of performing its primary operational mission, and that the Air Force requires Boeing's attention and improved focus on the KC-46. Finally, turning to space, the company has had problems there too. Despite the new Space Force branch of the military being a potential huge catalyst, Boeing in the fourth quarter of 2019 took a $410 million hit because on a test flight of its CST-100 Starliner, a timer problem forced the mission to be cut short, and a docking on the International Space Station had to be aborted. It is without question that Boeing has made a series of devastating mistakes in recent years. However, the recent free fall has pushed the stock back down, and perhaps that undervalues the company with a strong underlying business and bright future prospects. With over $15 billion in cash and strong support from government, Boeing will certainly be able to weather this period of global economic turmoil while working to recertify and produce the 737 MAX, assuming that the turmoil doesn't exceed 8 to 9 months. Once conditions improve, Boeing will come roaring back to life, according to many. For investors that enter now, there will certainly be assuming several notable risks, including high debt and uncertainty among airlines. But at the same time, this is a rare opportunity to buy a piece of a major industrial powerhouse with a duopoly on what not long ago was the hottest market in the world. Burry is not letting this opportunity pass him by.
They are correlated.
Discovery, 350,000 shares, $6.8 million. Discovery Incorporated is part of the communications services industry and the entertainment sector. They own and operate television networks in 220 countries and 50 languages. Discovery Channel, Discovery Kids, Animal Planet, Discovery Home and Health, the Oprah Winfrey Network, Travel Channel, and Eurosport are just some of the various networks owned by this company. Their library has more than 60,000 hours, which is 2 times the size of Netflix, and they produce over 8,000 hours of content per year. Discovery has plummeted in its value by more than 30% since the start of February, mainly due to the coronavirus sell-off, but also because of concerns regarding advertising revenue. The potential cut in advertising revenue is partially being set off with the increased viewing caused by the ongoing crisis. On the other side, Discovery added new direct-to-consumer channels recently that have increased their distribution revenue. For example, it has partnered up with giants like Netflix, Hulu, Sling TV, and they will be entering YouTube TV in the second quarter of 2020. It's easy to see the appeal of the Discovery company. They are the leaders of a market that has low competition, low costs, and an audience that loves their content. Whereas large content producers like Netflix, Disney, Fox, Comcast, and Apple TV are fighting it out to produce the best fiction content, which is extremely costly and unpredictable because nobody knows which will be the next blockbuster film or TV show, and for every hit there are hundreds of flops, Discovery plays a different game altogether. They produce the traditional non-fiction content with little competition and enjoy better financial statements than their peers. Discovery provides less scripted non-fiction content, with a cost per episode of about 10% of the cost of a fiction one. It is cheaper and much faster to film an episode of Animal Planet or of a cookery show, for example, than it is to film CSI Miami or Grey's Anatomy. This is the reason why Discovery has the highest margins of the industry and extremely robust cash flows. Because of the facts mentioned, Discovery is at a better position than its competitors to fund growth, to pay off their debt, or to repurchase shares. In 2019, management spent $1 billion on share buybacks, and their board just approved an additional $2 billion. Due to their financial strength, Discovery is better positioned to continue building new direct-to-consumer channels. Discovery reduced their debt considerably last year. They executed well, leaving an amount of debt that is manageable for them. This company earned above $11 billion in total revenue in 2019, the maximum it has ever earned. Their free cash flow increased by 28%, meaning they have the best free cash flow yield of the media giants. Even their president and CEO, David Zaslav, said, "We view ourselves as a free cash flow machine." During their last earnings call, Discovery also enjoys the highest EBITDA, earnings before income tax depreciation and amortization margins of the industry. Not only that, but they're trading at low multiples relative to their historical valuations and to their closest competitors. Discovery is undoubtedly a very stable company that is currently trading below its intrinsic value and that has a potential upside of roughly 40%. Burry likes it and it's easy to understand why. Facebook, 60,000 shares, $10 million. Another key change in the Scion portfolio is Burry's rotation out of Alphabet and into Facebook. The positions are about the same size, roughly, and so this does very much seem like a trade from one FANG to another. Alphabet will benefit from the pandemic with increased usage of YouTube. However, Facebook is also likely to see higher advertising inventory as usage increases while people stay at home. Both companies seem well positioned for the future to me, but Facebook has maybe more potential to increase advertising rates as their targeting efficiency and personalization improves over time. Facebook and Instagram are launching a feature called Shops, which enables business owners to create a free online store for all of their products. Customers can pay online and order delivery, and this is sure to prove popular with small businesses globally in a post-COVID-19 world, in view of social distancing requirements and the need to offer an alternative to brick-and-mortar stores due to the lack of football being a consideration for a while. There's also a captive audience of potential users of the shop feature. We can see that large numbers of people in India and the United States use Facebook regularly. Once they begin to use the shop feature, they may be more inclined later on to invest in targeted advertising to grow their businesses still further due to the simplicity of the platform and the fact that such features are integrated within the Facebook ecosystem. The growth rate and profitability of Facebook has been impressive for the last 5 years. Nevertheless, analysts still believe that it is underpriced and expect a target stock valuation of $300 in the medium term. Casino stocks. The one thing that I think is interesting about Burry's quarterly report is the number of call options that he has purchased. At the end of the quarter, he had 5 positions with call options, which allow for increased leverage to the upside. They allow holders to secure profits while waiting for investment to move in one direction or the other, which is why Burry also holds shares in many of the companies he has also taken out call options on. Wynn Resorts and Las Vegas Sands are both casino stocks, and this company's resort in Macau has already reopened. Burry's investment in Las Vegas Sands shares is just under $3 million. Plus, once travel reopens, it seems likely that for many Americans, certain destinations like Las Vegas will take market share away from package holidays abroad at first. There may be some reluctance, in other words, about going to China at this time, as well as the rigmarole involved in actually taking a flight. That could allow the gaming firms to recover more quickly than the market has expected, and if they do, this could augment their earnings substantially to the upside in Q2 of 2020. Jack in the Box, 300,000 shares, $10.5 million. This is a fast food outlet based predominantly in California with several outlets in Texas. There is no international exposure at the moment. Perhaps Burry likes the fact that this company is based fairly close to him in San Jose. Let's consider their location footprint. As you can see, out of 2,243 total units, a whopping 83% of the Jack in the Box stores are located in just 4 states. 42% in California, 27% in Texas, 8% in Arizona, 6% in Washington. The amount of geographic potential globally for this brand is enormous, yet untapped. The company has never tried the growth approach. In fact, the opposite is true, as the chain actually has 6 fewer units in operation today compared with back in 2015. If a big company took over and unleashed its network of global franchises, Jack in the Box could become a powerful, popular brand everywhere, providing yet further upside potential for the stock. This appears to be a fairly conservative play from Burry, who might not necessarily care that much about whether or not the company opens more outlets for reasons that I'm about to explain. The Jack in the Box share price has gone up from $18.59 to $68.23 between the 18th of March 2020 and the 11th of May 2020. Meaning, if you'd bought shares in this company on the 18th of March 2020, you would have made over $50 per share if you'd sold them on the 11th of May. Not that they've lost much value since then. The current share price is $65.38, but the 52-week high is over $90. Burry has already locked in a considerable price appreciation since he bought these shares before the end of March. This may actually be his biggest profit. He bought 300,000 Jack in the Box shares for $10.5 million, which works out to be $35.05 per share. Based on today's valuation of $65.38 per share, this is a price appreciation per share of $30.33. Multiplying that by the 300,000 shares gives a price appreciation of $9,099,000. So he has already made nearly $10 million from this company. Even if he sold the holdings, they would have produced better returns than the Taylor brand shares and probably compensate for the loss.
Oh, beautiful!
Meaning that this would have been a worthwhile investment even if there is no store expansion anywhere for Jack in the Box and he just unloads his shares for profit.